A key question in the global financial industry is how to maintain trust amidst heightened geopolitical tensions and technological challenges. It comes at a time when digital assets are emerging as a complementary force rather than a replacement for traditional rails, offering unique capabilities for instant cross-border settlements.
Governments and regulators play crucial roles in ensuring both infrastructure compatibility and system resilience globally. Singapore's regulatory approach demonstrates a balanced framework, ensuring comprehensive oversight of traditional and novel market participants, while at the same time maintaining flexibility for innovation.
And I'm delighted to say Kenneth Gay, Chief FinTech Officer at the Monetary Authority of Singapore, joined us now to look at this in more detail. Welcome, Kenneth, to Sibos TV. I hope you're comfortable on our new sofas.
Yes.
Let's get right into it. With
Sure.
heightened geopolitical tensions introducing uncertainty to global finance, what can governments and regulators do to engender confidence in the future of financial markets and payments?
Well, first, thanks for having me. This is my first Sibos, and I'm really excited to be here. The scale of this event, as well as the range of stakeholders that are here, is truly remarkable. To your question, I see three key ways that governments and regulators can engender confidence, and all of them center around building trust. First, we need to encourage interoperability. In times of uncertainty, our instinct is to turn inwards and to make our financial systems more isolated. This creates inefficiency and makes all of us worse off. We should instead look outwards and build systems that can work together for the common good. An example of this is Project Nexus, which connects the domestic instant payment systems of various countries in a multilateral fashion. This enables one instant payment system to connect instantly to all the other members of the network with one connection. Second, we need to double down on public-private partnerships. In these uncertain times, active collaboration between the public and private sectors is essential in fostering better outcomes. One such collaboration is Global Layer 1, a digital asset initiative with MES, as well as our public and private sector stakeholders, where we are looking to foster a digital asset ecosystem of compatible platforms that enables digital money as well as other assets, tokenized assets, to be transacted in using a common framework. Third, we also need to push ahead with global regulatory reforms. Standard-setting bodies such as the FSB, IOSCO, and CPMI need to press on with key areas such as AML, CFT, consumer protection, as well as systemic risk. Through this regulatory clarity, we not only foster financial stability, but we give the financial sector confidence in order to innovate.
Now, to follow up, Kenneth, how can these digital assets such as stable coins, CBDCs, and tokenized assets really complement traditional payment systems?
Well, first, I think it's important to recognize that traditional payment systems and digital assets serve different needs. Traditional systems are valued for their stability as well as trust, which in turn are engendered from their clear regulatory and operational frameworks. Digital assets, on the other hand, can bring about better speed, efficiency, as well as 24/7 settlement. So ideally, if we can bring the two together, we can have a financial system that is not only trusted, but can also meet new and evolving needs of the digital economy. MES's collaborations with the financial sector have shown that the financial sector benefits when different digital assets are used for different use cases. Let me give a few examples. First, in a collaboration called Project Orchid, tourists in Singapore can actually make payments to a wide range of local merchants in Singapore using the Tourist Home Payments app. And this is brought about because of stablecoins, which enables real-time settlement across borders. Second, in another collaboration called Project Guardian, we found that banks are able to achieve better liquidity management through the use of tokenized bank liabilities, and this enables 24/7 settlement. And third, MES is building a Singapore dollar or SGD test network where eligible institutions are able to carry out their digital asset transactions in a safer manner because they can settle using wholesale CBDCs. So what we can see from these examples is that in complementing traditional systems with digital assets, what's important is to understand the unmet needs of so-called that arise from traditional systems, and also choosing the right digital assets in order for the use cases to be met.
Tell us how Singapore is approaching regulation of new technologies, new payment technologies.
So MES's regulatory approach can be characterized by one core principle, which is same regulation for the same risk. We look at the underlying financial activity that takes place and not so much the technology wrapper around it. Let me give an example of Singapore's stablecoin regulatory framework, which we introduced a few years ago. When Singapore was thinking about regulating stablecoins, we didn't look so much at the technical details, such as the architecture or the chain. Instead, we focus on the key risks that stablecoins could bring, which is that of value stability. And we put in place a body of rules in order to address this key risk. For example, reserve asset composition, valuation, custody, as well as audit. So with this so-called risk framework in place, we are better able to regulate technology, whether it's traditional or novel. Besides this approach of same regulation, same risk, what we have also found helpful in our regulatory approach is to learn by doing. Earlier, I had shared a few examples of collaborations that we have with the industry. And these collaborations actually give us an early view into what are the regulatory considerations of new technologies and enables us to shape regulations that incorporate practical realities on top of the risks.
You've said that this is, in fact, your very first Sibos. So what is your message for the global financial community that's watching?
Right. My message will be threefold. First, the future of finance is interoperable. What this means is that we should not be caught up in chasing the single best technology or platform. Instead, we need to think more about driving value by connecting our existing and new systems and processes. By doing so, we would then be able to achieve real innovation, which comes about not from a single technology, but from bringing different technologies together. Second, we need to double down on collaboration. No single institution or country has all the answers. We need to harness platforms like Sibos to make not only new relationships, but also forge shared blueprints that can shape the next chapter of global finance. And finally, what I would say is that we need to take action now and not wait, because we can't wait for perfect clarity before taking action, and technological developments are moving really fast. So what we need to do, right, is to take careful, risk-controlled action, and this enables us to make progress as well. So to sum up, the future finance is interoperable, it's collaborative, and it's waiting for us to take action. Let's build the future of finance together.
Still thinking about the future of finance as cyber threats evolve, which is always an exciting topic at Sibos. And of course, new technologies like quantum computing emerge. How should financial regulators prepare their national infrastructures for these new, emerging, changing risks?
Yep, I think there are a few steps that we can take in order to prepare. First, I think, is to keep on top of the latest developments that are happening. A lot of technologies, for example, quantum, have a lot of potential in terms of their ability to improve the amount of computations that can carry out, or to also break or to create new and stronger crypto algorithms. We need to understand how these algorithms actually work in a practical manner by working closely with financial institutions and carrying out tests. In fact, MES recently announced a recent initiative where we indeed collaborated with different financial institutions on quantum key distribution. So this approach of actually first understanding the technology and then collaborating with industry is how we can address these threats.
And finally, just to wrap up, how would interoperability between digital assets and traditional payment systems really work in practice?
So I think in practice, we need to have three key considerations for interoperability. First, we need a clarity around the technical frameworks. In other words, what are the interface points between the traditional payments systems as well as digital assets, and how they actually fit together in a technical perspective. Second, we need clarity also around the rules that apply both to traditional systems as well as new systems. Participants need to understand what are the rules that apply to them, as well as how these rules apply to them. Finally, what's important also is operational processes, clarity on operational processes. When you combine a traditional system with a new system, there will be new operational issues that need to be taken into account. And market participants need to kick the tires quite rigorously on these processes before we take them live and bring them to scale.
Well, Kenneth, this has been great to have you on your very first Sibos. You certainly make the most of it, and you've certainly made the most of it for us as well. So thanks for sharing your thoughts on the Sibos TV sofa. That's Kenneth Gay, Chief FinTech Officer at the Monetary Authority of Singapore.